So in today's video, I'm going to be talking about the top 3 reasons why you might be struggling to acquire commercial real estate properties in 2024. What I'm going to talk about in this video applies to any asset class. Now, I particularly specialize in manufactured housing communities, large mobile home parks nationwide, but these principles will apply to any asset class you could think of. So let's talk about this. Here's a struggle you might be going through and who I'm really making this video for. If you're someone who is looking at tons of commercial real estate properties, you're making offers and you're just not getting any good traction, you're not being competitive against any of the other offers in the marketplace, or you're someone that, you think everything's overpriced, so you just aren't offering on things, or you're talking with sellers, you're talking with brokers, agents, you're looking at everything online, you just don't understand what you should buy and what you should get aggressive on. You keep talking with brokers about their deal listed, but you're never actually pulling the trigger. This is the video for you. So let's talk about issue number 1 that you probably have. All of the best buyers that I deal with, large national funds, private syndicators, and independent buyers that are great and are always buying properties, and guys that have giant private equity companies or publicly traded funds that are buying tons and tons of properties left and right. They all have a very specific buy box. And what I mean by that is, I know exactly what they want to buy and why, and they know exactly what they want to buy and why. They know it down to the exact type of utilities that they're willing to buy, the exact type of value add type properties. Is it a let's say mobile home parks? Is it a property where they want to rehab and sell off a lot of park-owned homes, or are they someone that's really willing to take on lagoon properties, or are they someone that really wants stabilized cash flow with light value add? They have do they know what market that they want to buy in? Okay, what are the metro stats of the market? They want secondary markets near major MSAs, but what does that mean? All right, they want 200,000 median home values. They want to see 50,000 plus median income. They want to see this, and this. They have very exact buy boxes. So when they see a property that's on market and it comes across their desk, or they find it online, or they cold call someone, and this is a type of property that hits their buy box, they are offering on that property 100% of the time, and they're trying to hit 80 to 100% of their best offer possible within what their buy box allows. So it's extremely defined what they are trying to buy. A lot of you guys that call me on, let's say any mobile home park listing, this particular week, I had multiple offer due dates for different properties I had listed, and I had tons and tons of conversations with, I would describe them as bad buyers or unsure buyers, and they'd run through the financials, then we'd go through this, we'd go through that. Usually I could tell they don't really know what they're doing when there's like some certain things in mobile home parks that they're asking questions on that they should already be able to imply through the financials, but no big deal. I've also dealt with buyers that are absolute pricks on the phone, and then they end up being the best buyer ever. But when we conclude the call, they'll just tell me how they can't get to this pricing, or they can't hit this, or they'll say, I'm trying to buy at a higher cash flow, or I'm trying to buy at a higher cap rate. And they say things like that without any actual specifics. And I always just ask them, well, what do you mean? Well, why will you not buy it at this cap rate? And then they'll usually have something, a response like, I'm looking for something a little better. And it's like, okay, so you're just never going to actually buy a property. So if something's listed at 13% cap rate and you're telling me it's not a high enough cap rate, well, first of all, what you should be asking of your experience is, why is this a 13% cap rate? I see everything's trading around 8 to 9% cap rates. But that's not what they're saying. They're saying something else, and it's all wishy-washy. Or they're saying like, the park's a little too rural for me. So it's like, okay, well then what's not too rural for me? Because I sent you a major MSA park that you instantly thought was overpriced, and then we sold at full ask a month earlier. So what is your buy box? Now, the best buyers that I deal with, they have extremely exact buy boxes. I know exactly what they want, why they want it, where, when, how, everything. So establish your buy box. Now, on top of establishing a buy box, once you have that buy box, you need to be pulling the trigger at every single property that hits that buy box. So have a very specific buy box so you know exactly what and when to make an offer on and what that looks like for your offer. This leads me into number 2 now. And part of that is developing your buy box, as I say. But the really biggest thing is, like, do you actually know how to underwrite? Let me unpack that a little bit. So you have a property, and it's a 8% cap rate. All right, $1 million property. It's cash flowing $80,000. Why are you worried about the cap rate? Have you looked at, well, how much capex is it gonna take to rehab this, and this at the property? What's your 5-year plan for this property? Are you looking for something that's an infill play, or are you looking for something with park on homes in place that you could rehab and sell off? Or are you looking for something that has really great park on home revenue and you could just restructure the rents, and that's how you're gonna get your net effective rents up and then refinance or sell later on? What is your value add strategy you're gonna actually go for? And then do you know how to underwrite that? So anyone that's worried about cap rates, I hate to hate on cap rates, but anyone that's worried about day one cash flow, honestly, you probably don't know what you're talking about. And the reason I'm saying that is it's not that day one cash flow is the problem. It's that every commercial real estate property has some type of inherent value add improvement business plan. The whole point of commercial real estate is you buy real estate, you improve the real estate, therefore increase its value, and then along the way you could cash flow or refinance, and now it's a cash flowing asset, or you sell it and move on to the next one. If you guys are super rich and you're trying to place money in a stabilized asset, that's a different story. But so many of you guys are not trying to place money in a stabilized asset. Otherwise, you'd be okay with 8 to 10% returns on your money because you're just trying to place your money somewhere. Yeah, okay, you want a higher internal rate of return. Yeah, there's different things like that. But really what you should be looking at is how quickly can I get my cash on cash returns to an acceptable amount? Whether this be an $800,000 CapEx property or a $100,000 CapEx property after down payment, closing costs and everything, like we'll get what cash on cash returns is acceptable to you and how quickly can you get it there. Some properties, you might have to put a lot of CapEx into it. But I mean, if you could raise the rents an acceptable amount where that CapEx is justifiable, then you could get 15% cash on cash by year 2, year 3. So you have to define to yourself, are you someone that wants to have 3 years of no cash flow and then eventually figure out what improvements you can make and lose money that entire time? Or are you someone like on the front end, listen, I want to buy a stabilized asset where I buy it, that's my down payment, I got no CapEx on the property. But you need to be able to define that, compare it to the marketplace, and see where people are actually falling with their pricings by making offers on things that hit your buy box. So you need to develop your buy box, learn how to underwrite, and make offers on everything that hits your buy box so you could actually adjust your underwriting to what the market's willing to pay. Every time people are telling me, oh, that deal's overpriced and it ends up trading with a good investor, when I underwrite it ahead of time, I'm seeing there's a roadmap to 25, 30% plus internal rate of return. Now, do I agree with that? If I was a buyer, would I be buying that property? I've sold properties that I thought were overpriced. Yeah. I personally would not go with this business plan. But someone who knows that submarket, who knows has surrounding properties, has scale of management, they might see that and say, no, I could probably infill 10 homes there in a year. Meanwhile, I'm assuming 6 homes per year. I think there's one park I just underwrote in Florida. I was going from 600 to 750 lot rents. One of the big operators I know here was like, we can go straight to 895. And I'm like, how do you know that? His park down the street's already at 950. So there's a whole different understanding of underwriting. And really it's like, can you paint a picture of profitability with this deal? And then is that roadmap to that profit something that I want to do? Am I someone that wants to go dish out $700K and not cash flow for 3 years? Yeah, it doesn't work for me. I'd rather be someone who dishes out, $250K, still has a little bit of cash flow, and I could just slowly raise rents over time. Okay, define that. And really what you're looking at is how quickly can you get cash on cash returns? You can't, it's hard to predict what your exit's going to be because the exit cap rate or disposition cap rate is going to change depending on interest rates in the overall market. And then when you buy the deal, the cap rate doesn't matter because you're going to get debt on the property anyways. And then you have to invest money in the form of CapEx, capital expenditures, to try and improve the property. So really, when you're focused on underwriting properties, you have to think, all right, how quickly can I get cash on cash returns, aka real cash flow based on the money invested? And how long is that going to take me? That's what you need to be calculating for, and you need to understand how to underwrite that. And that's going to be specific to you. It depends what type of value add strategy you like. If you decide I'm someone that wants to find a mom and pop park with a lot of park on homes and a lot of park on homes that are below market rent, so I could go in there, essentially sell the homes off or give the homes away and raise the lot rents, like reallocate the rents. If that's your strategy, then don't go look at this infill property over there. You're not going to compete on that because people who compete on that are the ones who know how to underwrite that and perform on that. Meanwhile, you are looking for this. So define what you guys are looking for. And now the very third thing that would really help a lot of you guys, both on the buy side and the sell side, it's going to be understanding your buyer and seller type. Let's talk about your seller type. If let's say you developed your buy box, you understand how to underwrite, you know what properties you're going for, and you understand what returns you're looking for. Look how that matches up against the market. If you are 10 to 20% below where everything on market is trading, well then newsflash. Either you have to change your returns expectations or you need to learn how to go off market direct to seller on your own. When an idiot first time buyer wholesaler reaches out to me when I have a publicly listed property, and let's say I have a publicly listed property at $4 million and they're telling me there's no way anyone pays more than 3.2 for this. And then I actually have in hand already multiple offers from credible guys at 3.8. Instantly, I already know this guy's a fucking idiot. He doesn't know how to underwrite, or he knows how to underwrite, but he's too stupid to realize going to a publicly listed property with an established mobile home park broker probably isn't a good idea if I'm trying to lowball. Like, there's always a balance of lowballing. Yes, you should be, now that rates have went up, as a buyer, you should always be trying to lowball and try and push for the lowest price possible. I mean, honestly, lowest price, highest returns. But this needs to be within reason. You have to understand where the market's at, and the only way you understand where the market's at is you're in the market making offers and getting responses. This ties into one other thing. So yeah, if you're someone that wants to buy something with crazy returns significantly higher than typical market rate, then obviously you have to go direct to seller off market. And if you're trying to ask brokers to send you off market deals, that's not going to get you anywhere. Why would I send you an off market deal when I have 7 other buyers that have way higher likelihood to close, own properties nearby, are willing to pay me $20,000 on the side aside from the commission of the deal? Like, there's so many reasons why I should not send it to you as a buyer. Just ask for off-market deals, who isn't even decided on what he wants to buy and has no decision-making capabilities because he just hasn't bought anything the last year and a half. So like, forget, you need to learn how to go direct to seller yourself if you really want to get a home run deal, or you have to learn how to really negotiate and extract value through underwriting properly for the on-market deals. Let's talk about seller financing really quick, just as a bonus. I know I was only talking about 3 topics in this video, but seller financing. So the only little bonus nugget I can give you there is when you're talking with a broker or an agent, don't ask them, is the seller willing to finance the deal? Obviously, if it's not mentioned in the marketing, they want a cash offer. That doesn't mean they're not willing to seller finance. But you need to ask questions whether they are even in the position to seller finance and what their situation is. If someone owns a property outright in cash and they're just looking to retire and they're tired of operating this park, that's a perfect seller finance opportunity. Hey, let's say it's $1 million. I can give you $200,000 to $300,000 down day one. I could give you 6 to 7% interest rate, interest only payments for 3 years, and then a balloon at the end of year 3. So you're getting a huge chunk up front so you can go vacation and retire. I'm going to make you the same payments that are similar to even the net cash flow of your property. And then at the end of it, you're going to get the whole remaining balance in all in full. But how did I know to do that seller finance term? I asked what the seller's issues are, and I tried to propose a solution that's mutually beneficial. I get me more favorable debt terms. The seller gets what ultimately accomplishes their goal. Now, on the flip side, let's say you're talking with a property, and you just ask the broker, is the seller willing to seller finance? But the seller has like 60 or 70% of the property's value in debt. There's no seller finance capabilities. There's too much debt on the property. But you look like an idiot now because you asked that without even clarifying, would it even make sense to seller finance? Like, this isn't just like, oh, people talk about seller finance is beneficial, let's just throw it out and just with zero understanding, just throw it at deals. Like, you should be asking, what is the seller motivated to sell? How long has it been on market? Has he been trying to sell? Is there a reason he's selling that he needs to get rid of it soon? Or is he willing to wait and stick it out 6 more months for his offer? If that's the case, he's probably not going to seller finance. Oh, this person has minimal debt on the property. Just his wife got diagnosed with cancer and he really needs to sell in the next month and a half. I know his number's crazy, but he needs to get to it. Well, now think, all right, if I can hit his number, he needs to sell in the next year and a half. He has no debt on the property. Now it makes sense to propose a seller finance offer. So you guys need to understand when someone actually can seller finance. You need to ask, are they even qualified to seller finance me the property? Are they qualified to be creative? Because just trying to throw out creative ideas. If someone's saying, I want $5 million cash, and you're like, I'll give you $3 million seller finance, it's like, who even are you? Meanwhile, all right, they want $5 million. Listen, you explain to the broker, listen, I'm underwriting the property. at the absolute highest, and I know you know this, based off the lot rents, you know, a lender's probably going to only finance this up to like 4.2, 4.3 million. It's really not going to make any sense at 5 million. Does the seller have debt on it? Like, what's their situation? Are they desperate to sell? Are they willing to wait 3 or 4 months? If you go through that and I give you the questions, now you can start to formulate a creative offer. All right, maybe they won't sell their fans, but you tell them, listen, I could probably get bank finance and do like 3.6, but then I'll need the other like 1.2, 1.3 as like a seller carry second position. Like, I'll cover their debt. They'll walk away with some cash at closing, and they'll get payments. But like, you and I both know he's not going to get 5 million. See how I created a mutually beneficial scenario? The broker's on your team. The broker wants to get a deal done too. The broker's just not on your. If you ever feel like brokers are against you, it's only because you are asking dumb questions or you don't know what you're talking about. Brokers want to get the deal done, and if you're a good buyer, we want to get the deal done. I know I need you to complete this transaction, but if you're asking things that are clear, like, all right, there's almost a 0% chance you're ever going to buy this property. Of course, the broker's a dick to you. So, hope this video is helpful. This is kind of your crash course on how to successfully buy properties. If you're struggling to, honestly, if you can't buy a few properties within a year, you're probably the issue, and you're not looking hard enough in the market, because transactions are always happening and very profitable transactions are always happening. We're not in like some crazy market crash right now, although it is a tough cycle. It's definitely a tougher cycle than lower interest rates. But when it was lower interest rates, everyone was complaining about how the prices don't make sense. And then now interest rates went up and people are complaining how the prices don't make sense. And it's like, all right, so prices don't make sense when interest rates are low. Prices don't make sense when interest rates are high. Maybe you just don't understand pricing. So keep that in mind, guys. Hope you enjoyed this video. Don't forget, like and subscribe. If you guys want to learn how to find off-market commercial real estate properties direct to seller and all of the tips, tricks, and tools that I use to have brokered over $100 million worth of properties, CREDealAccelerator.com. I have a free guide on there. It's 100% free. It is every single research tool and process that I use to rapidly source off-market direct to seller commercial real estate deals. And if you're a mobile home park owner and you want to get a free evaluation, I have the best underwriting in the marketplace. Our team is top notch. Our analysts used to work for all big banks. They were big analysts underwriting huge portfolios. They understand how they extract value to every little piece of upside. So if you're looking to get a true market value, like what is your top of market value, realistic price you could sell your park for, sign up for a free evaluation on my website, mhpvalue.com. Appreciate you guys for watching. And don't forget to subscribe on YouTube if you're watching there. Peace.